Welcome back to The Exchange. It's time for today's 3 buys and a bail, and we're digging into the retail names which are about to report. Joining me now is Gina Sanchez, Chief Market Strategist for Lido Advisors, CNBC contributor. Gina, welcome to you. Let's start with Abercrombie, which has made an amazing comeback over the years and decades. Okay, the shares are up 400% just in the past year as denim is now totally back in fashion. But investors are wondering whether the company can keep up the momentum. Should you buy it here?
So Abercrombie's interesting. They have been very cautious in their guidance. I think, all of that trauma from the last several years. However, if you look at the fundamentals, they're very much set up for a beat, but they're also expanding their margins. They've been able to raise their prices with the trends in their favor, but also costs are falling. And so I think all in all, they're setting up to be one of the stocks that can defend well if we start to see a softening consumer.
So, I mean, look, 18 PE is pretty remarkable given the run that they've been on. It's not that high yet, and maybe the denim trend still has legs, so to speak. Okay, let's move on to Chewy then, which is down 45% over the past year, but Wedbush sees modest upside potential in sales. Do you also see some bright spots here? And this one's heavily shorted as well.
Yeah, so this is an interesting one. So they've been losing active accounts, and that I think is a part of what has been feeding a lot of that shorting behavior. But you've also seen them expanding their net sales to the current accounts that they have. So that could offset it. They're also going into a season when they should go into some pretty easy comps. And so that in and of itself could also kind of make some of those shorts reconsider. And, the bigger challenge is whether or not they can sort of fix their operating margin. And it seems as though they're starting to sell more profitable channels on the Chewy platform. And so if that is the case and they start to make up some of that negative leverage that they have, that could also be very beneficial in the long run. So combination of easier comps, selling more profitable products, they're moving in the right direction.
Given what's been going on with the meme stocks lately, we'll see if we get some big action tomorrow. Your final buy is Dick's, which I was surprised to find out is up 33% this year. Why?
Yeah, so Dick's is one. This is one where they've actually been hit by by increasing costs. However, they've also had very, very strong sales, and a lot of that is seasonal sales. So they might go into sort of a harder comp season, kind of going near term, but if you sort of stretch that out over the year, they should be able to make up and get back to strong profitability. So the outlook for Dick's is actually still quite good.
And your bail, Advance Auto Parts. I think my Virginia, company, they just I don't know how we fix them at this point, but you're staying away.
So, yeah, we're staying away because they have been trying to execute a kind of strategic pivot in order to try to fix the profitability problem. But they're doing it at a time when, quite frankly, it's been a great time to be in, in sales right now, selling to consumers, and they haven't benefited from that. We're going to a time when that should soften. So that pivot is just going to have more headwinds. So, this is a challenge that could take them years, not months.
Yeah, North Carolina based, but we got to go see the factory or some sort of regional headquarters in college. You never forget those, the first time you go on these reporting trips. Gina, appreciate it very much. We'll see how everyone comes in when they report their earnings. Gina Sanchez with Lido Advisors.